In 1848, a merchant in San Francisco bought up every shovel he could find for 20 cents apiece. He sold them back to desperate miners for $15 each, becoming the wealthiest man in California without ever mining a single flake of gold. Today, Silicon Valley is running the exact same play on a scale that defies comprehension. The modern shovel is NVIDIA's H100 microchip. The tech giants are buying them by the trainload. But in the private suites of venture capital, a quiet panic is taking root. What happens if the miners never find any gold? Every quarter, tech giants must defend an unprecedented hemorrhage of cash. Wall Street is demanding proof of return, but the executives are trapped in a classic, high-stakes prisoner's dilemma. Google chief executive Sundar Pichai captured the industry's systemic anxiety, stating that the risk of underinvesting is dramatically greater than the risk of overinvesting. If Microsoft freezes its chip acquisition while Google accelerates, Microsoft risks immediate obsolescence. So, the spending spiral continues, driven not by clear consumer demand, but by existential fear. This defensive buying has created a massive structural imbalance hidden behind a wall of corporate optimism. The math behind this imbalance is simple, brutal, and public. David Kahn, a partner at Sequoia Capital, mapped out the industry's baseline financial requirements. It begins with NVIDIA's projected chip revenue, a run rate that represents pure capital expenditure. But a microchip does not run on a bare desk. It must be housed in a specialized data center, cooled by millions of gallons of water and fed immense amounts of electricity. This physical infrastructure roughly doubles the initial cost of the hardware. Finally, the software startups buying these servers must turn a profit, requiring at least a 50% margin to survive. Multiply these factors out, and a terrifying reality emerges. The artificial intelligence sector must generate $600 billion in annual revenue just to break even on its physical footprint. $600 billion is the baseline for survival. Today, actual revenue is a rounding error. OpenAI, the market leader, operates at an estimated annualized run rate of just $3 to $4 billion. Add the revenue of Microsoft Copilot, Anthropic, Midjourney, and every other major player, and you barely scratch the surface of that mountain of debt. The deficit is not a temporary operational bottleneck. It is a multi-hundred billion dollar structural chasm. To make matters worse, many venture-backed startups are merely thin wrappers built on top of OpenAI's models. As API costs drop and the underlying models absorb their features, these startups face immediate obsolescence, leaving investors holding empty bags. This financial deficit is colliding with the hard laws of physics. Data centers are cannibalizing local power grids, forcing tech giants to hunt for unprecedented energy sources. Microsoft recently signed a 20-year agreement with Constellation Energy to resurrect a decommissioned nuclear reactor at 3 Mile Island, solely to feed its data centers. But this insatiable demand is already squeezing local communities. In the tech hubs of Northern Virginia, residents are watching their utility bills rise while the low-frequency hum of cooling fans echoes through their neighborhoods. The virtual cloud has arrived on Earth as a heavy, resource-hungry industrial machine. We have seen this economic pattern before. In the late 1990s, the telecom sector spent billions laying millions of miles of fiber optic cables, betting on an immediate explosion of consumer internet traffic. Cisco Systems, the company selling the routers and switches that powered the boom, became the most valuable public company on Earth in March 2000. But consumer demand lagged behind the infrastructure. The build-out stopped, the bubble burst, and Cisco stock crashed by 90%. A high-water mark it has never reclaimed. Today, NVIDIA occupies the exact same vulnerable position as Cisco did 24 years ago. But there is a historical paradox. While the fiber optic crash wiped out investors, those millions of miles of high-capacity glass cables did not vanish. They sat silent in the ground, depreciating to near zero. A decade later, that incredibly cheap, overbuilt infrastructure made the modern internet possible, giving birth to YouTube, Netflix, and the global app economy. If the current artificial intelligence bubble bursts, the cycle will likely repeat. The advanced chips and massive power stations built today at the expense of Microsoft and Alphabet will eventually become cheap, abundant commodities, paving the way for applications we cannot yet imagine. The tech giants of today are not the fragile, cash-strapped startups of the dot-com era. They are the most profitable empires in human history, backed by hundreds of billions in free cash flow. They can afford to burn capital for years in this high-stakes game of survival. But the laws of economics are patient, and eventually, the bill comes due. Whether this systemic deficit triggers a brutal market correction or quietly builds the foundation for the next century of computing, the physical architecture of the future is being laid today, even if we have no idea how to pay for it.